Jyotivardhan Jaipuria, the founder and MD at Valentis Advisors, is joining us on the show. Hi, Jyoti. Good to be speaking with you. Let's begin by that discussion itself. FY25, what one should watch out for? Should we temper in the expectation after that solid 28-29% rally on Nifty in FY24 and 70% gains from the small cap index?
Yeah, so there are two easy things to say. One is FY25 won't give the same return as FY24. The second is there'll probably be more volatility in FY25 than we saw in FY24. Because FY24 was one of those dream runs where the market just kept going up one way. So it's very natural, right? That once you get, let's say, 25% return on the Nifty and, valuations move up. So to some extent, you need a consolidation. I think it will be healthy for the market if we get a period of consolidation because that will help valuations come down to little better levels.
Okay, let's see whether those valuations come down to better levels or not. But I wanted to get sector specific and talk about the real estate sector. Of course, today it's coming off a bit after that solid rally over the last couple of days. But what about the next 12 months? After the run up of almost 60-70% in calendar year 23, do you think that there could be a bit of tempering down there as well and it's case for a profit taking? Or given it's a multi-cycle, multi-year upcycle, one should continue holding on to positions there?
Yeah, so Anisha, what we'll have to think now is, I think the cycle will play for a long time. So I think the whole capex cycle, the government spending and India doing well will play for some time. At the same time, stocks go up a lot and then there's a period where they don't really go up. They need to consolidate the gains. You need to start seeing earnings really flow through. So to that extent, real estate and a lot of other sectors may be in that zone where, the next 6 months may be tough in terms of stock price when people are consolidating. Now people are saying, okay, show me all the earnings before we have the next leg up in these stocks. So for people who want to book out and then try to get back in again, it may be a good opportunity to do that. Otherwise, for people who just want to ride out a wave for the next 3-4 years, then you can hold on to a lot of these, I would say the capex related stocks.
Will the view be similar when it comes to the PSU stocks as well, whether it's defense, whether it's OMCs, whether it's power stocks?
To some extent, yes, but we split all of them into different segments because they all belong to different segments. So, for example, defense, our view has been that probably they've run up a slightly ahead of themselves. It's again a good 3-year, 5-year story, and assuming the government policies don't change over the next 5 years. But at the moment, the stocks are factoring in too much of everything getting done to perfection. I have the order book here, then I will implement to perfection. So I think what we need is a bit of pause, a bit of earnings to really reflect in these companies. The order book translates into sales, and we get profit numbers before we have a next leg up. So a little more cautious there. Think like OMCs have not done as well if you think about it. So there's always a concern before elections whether the price hikes will be allowed. But post elections, if price hikes are allowed, then probably OMCs is one of the cheaper things in the PSU basket.
Okay, so despite the run up in the last 3 to 4 months, a bit of a correction has come in OMCs and perhaps it's still a good buying opportunity. But what's the view in terms of what could be the dark horses? Do you think IT and pharma, which haven't been loved enough by the street, could potentially give more returns?
Yes, these both show up on our screens because, we have this whole philosophy of buying stuff which is under-owned and which is underperformed. So both of these are showing up on our screens. The one where we have acted actually and where we have done well, we've been buying pharma a lot over the last 1 year. And in pharma, we've used that the US generic cycle, which is, it was like falling year after year for the last 6-7 years. That cycle is bottomed out. So from here, US generic pricing will be flat to slightly better. And that, provides a lot of room for these pharma companies to do well. IT is something we're still not, bitten the bullet in some sense. We keep looking at it. So one worry I have there is that, the US corporate earnings may not be as good. And once the corporate earnings start to weaken, the whole IT spend environment will weaken. Longer term, the worry I have there is artificial intelligence, because what that may mean is that the number of people required to do the same job could come down quite a bit. That, will be a longer term problem for these IT companies in India.
Okay, so still on the sidelines when it comes to the IT companies. watching out for the earnings cycle in the US as well, but pharma is one space that Jyoti has been nibbling into over the last 12 months as well. But which are the spaces that you would say one should avoid at this point of time? Is financials one space you believe, the private banking names?
We are a little against consensus here. We've actually been buying some financials at this stage, and we understand the same concerns which everybody has, that the NIMs have gone up a lot and NIMs are going to come down. And this, I think, is a very normal cycle. So if you think of any interest rate cycle and interest rates start to move up, the first move for banks is, they have a big surge in NIMs because loans reprice much quicker than deposits. A year later, the deposits start to reprice and your NIMs come down. The reason we like them is two. Is, when you look at valuations in India today, relative valuations are probably still good for the banks relative to a lot of other spaces. So banks is one of the cheaper places that you have today. The second is, I think there'll still be a growth in the economies. There'll still be growth in credit. And, the NPL cycle, I think, will not start for the next few years at least. So to that extent, bank will be a good space, though NIMs pressure will be there. You'll still see earnings going up because your credit offtake will be decent and, credit costs will be under constraint. So to that extent, at these valuations, we are in fact relatively buying banks rather than selling them.
Okay, relatively buying banks rather than selling, getting incrementally positive on that. But what about some of these niche segments, textiles, chemicals, anything that's coming up on the radar in some of these ancillaries?
We don't own textile per se, but textiles is in a decent spot just now because you'll have a lot of raw material prices coming down there. So for a lot of the textile companies, you find, because cotton prices have come down, you can have margins which go up because of, raw material pressure easing. And, they probably will do well. The reason we don't buy them is one, liquidity in a lot of these stocks is a problem. And secondly, they're very cyclical. It's like, raw material prices come down this year, they can go up next year, then again margins get into pressure. Chemicals is something which we are watching closely. We still think it's like a couple of quarters away, but we think a lot of these agrochemicals, the destocking has started. So to that extent, over the next 6 months, I think we will be adding to chemicals. I think that's one space which investors should watch out and probably buy in time whenever they want to, depending on their patience level. But it's something from our point of view is probably over the next 1-2 quarters, we'll be adding to that space.
Okay, on that note, we'll let you go. Thanks so much for making time and speaking with us. So that's the view coming in on a whole host of sectors, financials, pharma, IT, textile, and a whole lot of other sectors as well to watch.
If you like this video, then like, share and subscribe to ET Now.